The phones went silent last Tuesday at 3:17 a.m. Shanghai time. Not all phones, just the specific ones that matter. The ones that connect silver refineries in Switzerland to procurement managers in Shenzhen. The ones that link London vault operators to battery manufacturers in Guangdong province. For 48 hours, the global silver supply chain experienced something unprecedented. Not a shortage, not a spike, something more fundamental. A decoupling. While Western markets celebrated another successful paper market pricing campaign, driving futures contracts down to seemingly reasonable levels, something extraordinary was happening 8,000 miles away. Physical silver in Shanghai began trading at premiums that defied every traditional arbitrage model, 12%, 15%. Numbers that should have triggered immediate correction flows. Numbers that should have brought metal flooding in from London vaults and New York warehouses. But the metal didn't come. The arbitrage didn't work. The system that has governed global silver distribution for decades reached the limits of its historical operating assumptions. This discussion is for educational and analytical purposes only, and does not constitute financial advice. What we witnessed wasn't market volatility. It was a phase transition. The moment when decades of gradual industrial demand growth crossed a threshold that conventional financial mechanisms struggle to counteract. The moment when the physics of supply and demand reasserted dominance over the mathematics of derivatives trading. We have entered the compression zone, where paper promises begin to separate from physical reality, and where regional markets start exerting increasing influence over pricing dynamics. The Shanghai premium isn't a trading anomaly. It's a symptom of structural transformation occurring in real time across multiple industrial sectors simultaneously. 3 separate technological revolutions are converging on a single element, creating demand patterns that mining companies never anticipated and refineries were not originally designed to accommodate at scale. The first revolution involves photovoltaic technology, where advances in N-type solar cell efficiency have doubled silver consumption per panel, just as China scales production to supply global green energy transitions. The second centers on electric vehicle battery systems, where solid-state technologies promise to solve range and safety issues by incorporating silver-based anode materials. The third encompasses advanced electronics manufacturing, where 5G infrastructure, Tour and artificial intelligence hardware require unprecedented quantities of high-purity silver components. Each revolution alone would strain existing supply chains. Combined, they represent a fundamental shift in how civilization consumes this particular element. We are witnessing the transformation of silver from a precious metal with industrial applications into a strategic material essential for technological infrastructure. The chemistry driving this transformation reveals why substitution remains elusive despite rising costs. Silver possesses the highest electrical conductivity of any element at standard temperatures, a property that has yet to be matched by commercially viable alternatives. In photovoltaic applications, silver paste typically contains between 60 and 80% silver content, rising to 90% in high-efficiency panels. Over 85% of global silver paste demand originates from solar manufacturing, with the solar industry now consuming approximately 19% of worldwide silver production. This concentration creates what materials scientists term inelastic demand. Unlike decorative or traditional monetary applications where price sensitivity can reduce consumption, industrial applications require specific performance characteristics that only silver can provide. Any efficiency gains achieved through silver reduction must be weighed against the increased number of components required to maintain output levels, often resulting in higher total silver consumption despite lower per-unit loading. The technological transition to N-type solar cell architecture exemplifies this paradox. These advanced cells offer superior energy conversion efficiency, but require double the silver loading compared to previous PERC technology. China's near-complete adoption of N-type production coincides with manufacturing expansion that has captured over 90% of global panel shipments. The mathematical implications are stark. Chinese authorities report 675 gigawatts of wafer manufacturing capacity, translating to approximately 6,750 tons of annual silver consumption for solar applications alone, assuming industry estimates of 10 tons per gigawatt remain accurate. Current baseline global silver demand approximates 1.2 billion ounces annually across all applications, with industrial uses consuming roughly 700 million ounces. Solar photovoltaic manufacturing accounts for approximately 200 million ounces of this industrial demand, representing the largest single industrial application category. If solar deployment follows historical renewable energy adoption curves, conservative projections suggest photovoltaic silver demand could reach 273 million ounces by 2030, representing a 170% increase from current levels. Moderate adoption scenarios, incorporating aggressive climate policies and continued cost reductions, indicate potential demand approaching 350 million ounces annually within the decade. Aggressive scenarios, driven by breakthrough storage technologies and complete fossil fuel phase-outs, suggest solar silver consumption could exceed 450 million ounces by 2035, approaching 40% of current total global demand. These projections assume current silver loading rates remain constant. However, ongoing efficiency improvements in photovoltaic technology consistently require increased silver content per panel to achieve target performance specifications. The industry faces a fundamental optimization challenge where material cost reduction conflicts with efficiency maximization, and efficiency typically wins due to installation and land use economics. Parallel demand growth from electric vehicle and electronics sectors compounds these consumption projections. Solid-state battery technologies, currently transitioning from laboratory development to pilot production, incorporate silver-based anode materials to prevent dendrite formation during rapid charging cycles. Early estimates suggest high-performance battery packs could require between 50 and 200 grams of silver per vehicle, depending on capacity and charging speed requirements. Global automotive production approaches 90 million units annually. If electric vehicle adoption reaches 50% market penetration by 2030, with solid-state technologies capturing 20% of the electric segment, additional automotive silver demand could approximate 50 million ounces annually. Advanced electronics manufacturing, driven by 5G infrastructure deployment and artificial intelligence hardware requirements, contributes another estimated 75 million ounces of incremental annual demand over the next decade. Combining these demand vectors suggests total industrial silver consumption could approach 900 million ounces by 2035, compared to current levels of approximately 700 million ounces. This 200 million ounce increase represents nearly 25% of current global mining output, occurring simultaneously with continued jewelry, silverware, and investment demand. Supply response capabilities remain constrained by geological and operational realities that financial markets have historically tended to underestimate. Global silver mining production has remained essentially flat since 2014, averaging between 820 and 850 million ounces annually, despite significant price appreciation over the period. Approximately 70% of silver production occurs as a byproduct of base metal mining operations, meaning silver output depends primarily on copper, lead, and zinc demand, rather than silver prices specifically. Primary silver mines contribute only 30% of global supply, limiting the industry's ability to respond to price signals through dedicated production increases. New mine development requires 10 to 15 years from discovery to commercial production, meaning supply responses to current demand growth are unlikely to materialize until the mid-2030s at the earliest. Meanwhile, existing mines face declining ore grades that require progressively more energy and resources to maintain output levels. Mexican and Peruvian operations, which collectively account for nearly half of global silver production, operate under increasingly complex political and environmental constraints. Recent regulatory changes in Mexico have restricted new mining permits, while social tensions in Peru regularly disrupt operations through strikes and blockades. These jurisdictional risks intensify as silver prices appreciate, and local governments face pressure to capture larger portions of mining revenues through taxation or nationalization. Recycling provides limited supply augmentation due to silver's dispersed industrial applications. Unlike gold, which concentrates in easily recoverable forms, industrial silver becomes permanently embedded in electronic components, solar panels, and chemical processes. Historical recycling rates approximate 20% of annual consumption, far below the 90% rates achieved with gold. Much industrial silver becomes functionally unrecoverable, buried in landfills or incorporated into infrastructure with decades-long service lives. Market pricing mechanisms struggle to accommodate non-linear demand transitions occurring across multiple industrial sectors simultaneously. Traditional commodity analysis assumes gradual supply-demand adjustments mediated by price signals that encourage substitution or conservation. However, technological transitions often create step function demand increases that overwhelm existing supply buffers before pricing mechanisms can respond effectively. Historical precedents suggest markets consistently underestimate the magnitude and persistence of structural demand shifts. Palladium experienced similar dynamics in the early 2000s when automotive catalytic converter adoption exceeded supply projections, driving prices from $200 to over $3,000 per ounce. Rhodium followed comparable patterns during emissions regulation implementation, reaching $29,000 per ounce as industrial users competed for limited supplies. The Shanghai premium phenomenon indicates this structural adjustment process has begun for silver. Chinese industrial consumers, facing immediate supply constraints for critical manufacturing processes, demonstrate willingness to pay substantial premiums for guaranteed delivery. 12 to 15% premiums above London and New York pricing create powerful arbitrage incentives that under normal market conditions should equilibrate prices across global markets. However, arbitrage flows require available inventory in source markets, adequate transportation and financing infrastructure, and sufficient time for logistics completion. When demand growth exceeds these capacity constraints, regional premiums can persist for extended periods until new supply sources develop or demand patterns shift. The magnitude and persistence of Shanghai premiums suggest fundamental supply-demand imbalances rather than temporary market inefficiencies. Physical inventory data supports this interpretation. Shanghai Futures Exchange silver stocks have declined 70% from 2021 peaks above 3,000 tons to current levels below 900 tons. This dramatic reduction occurred during the period of maximum Chinese industrial expansion, indicating consumption rates that consistently exceeded replacement flows despite aggressive import efforts. Warehouse inventory dynamics reveal the tangible manifestation of supply stress across the global silver distribution network. From January to May 2024, Chinese markets received 1,663 tons of silver deliveries, with analysts projecting nearly 4,000 tons of total annual imports. These volumes represent unprecedented peacetime metal flows, yet proved insufficient to prevent continued inventory drawdowns and premium expansion. Human psychology during structural transitions creates predictable but often counterproductive market responses. Initial phases typically generate skepticism as traditional analysis frameworks struggle to accommodate non-linear demand patterns. Financial media focuses on familiar metrics like mining company earnings and traditional jewelry demand, while missing industrial consumption data that drives fundamental supply-demand dynamics. Professional traders and institutional investors frequently interpret early shortage signals as temporary market imbalances that will self-correct through normal arbitrage mechanisms. This assumption works well during cyclical demand fluctuations, but fails during structural transitions, where arbitrage capacity becomes overwhelmed by sustained demand growth. Market participants often resist acknowledging structural changes until overwhelming evidence forces recognition, creating delayed price adjustments that can appear sudden and dramatic when they finally occur. The Shanghai premium suggests this recognition process is beginning as Chinese industrial users demonstrate willingness to pay significantly above global benchmark prices for guaranteed supply access. Skeptics commonly argue that high prices will inevitably reduce consumption or stimulate substitution, restoring market balance without sustained premium pricing. Historical evidence suggests this argument applies primarily to price-sensitive applications like jewelry and silverware, while industrial applications with specific performance requirements demonstrate much lower price elasticity. Additionally, technological transitions often occur during periods of strong economic growth that provide industrial users with sufficient cash flow to absorb higher material costs rather than compromise production schedules. Chinese solar manufacturers, supported by substantial government subsidies and facing enormous domestic and international demand, exemplify this dynamic. The compression phase we have entered reflects the collision between exponential industrial demand growth and linear supply expansion capabilities. Physical reality is beginning to assert dominance over financial engineering as markets discover that derivatives trading alone cannot expand physical supply when fundamental shortages develop. Regional pricing divergence indicates the early stages of system adaptation under constraint, where local supply-demand conditions override global benchmark pricing. This structural transformation appears increasingly difficult to reverse, given the scale of technological changes driving demand growth. Solar energy deployment, electric vehicle adoption, and advanced electronics manufacturing represent civilization-scale infrastructure transitions that will persist regardless of short-term commodity price fluctuations. The physics of these technologies requires silver's unique properties, creating demand patterns that no amount of financial innovation can eliminate. The Shanghai premium signals that industrial reality has begun to diverge from financial market pricing. Physical allocation decisions are increasingly influenced by supply security rather than benchmark costs, suggesting the emergence of a two-tier market where guaranteed delivery commands significant premiums above paper contract prices. This evolution toward physical scarcity pricing represents the natural market response when essential materials become genuinely constrained rather than merely expensive. What happens when the mathematics of industrial demand collides with the physics of planetary geology? When the quiet assumptions underlying global supply chains encounter technologies that consume materials faster than Earth can produce them? We may be witnessing the answer in real time, manifested through pricing anomalies that traditional market analysis cannot explain. The data emerging from Asian trading floors suggests something unprecedented is occurring beneath the surface of familiar commodity charts. Regional price differentials that should disappear within hours through normal arbitrage mechanisms have persisted for months, expanding rather than contracting despite enormous financial incentives for correction. These differentials indicate not temporary market inefficiency, but fundamental structural change in how critical materials flow through industrial systems. This discussion is for educational and analytical purposes only, and does not constitute financial advice. The transformation appears rooted in solid-state battery technology, a breakthrough that promises to resolve the most persistent limitations of lithium-ion energy storage, while fundamentally altering how civilization consumes one particular element. For decades, battery engineers have pursued the holy grail of energy storage: cells that charge rapidly without thermal runaway, store more energy per unit weight, and operate safely across extreme temperature ranges. Traditional lithium-ion batteries fail these requirements due to liquid electrolytes that enable dangerous dendrite formation during rapid charging cycles. Dendrites are microscopic metal filaments that grow like crystalline spikes inside batteries during charging, eventually piercing the separator membrane between positive and negative terminals. When this barrier fails, the battery short circuits, generating heat that can trigger catastrophic thermal runaway and fire. This fundamental chemistry limits charging speeds and creates safety risks that have constrained electric vehicle adoption and energy storage deployment. Solid-state battery technology eliminates liquid electrolytes entirely, replacing them with ceramic or polymer materials that conduct ions while preventing dendrite formation. This breakthrough enables rapid charging without safety compromise while dramatically improving energy density. However, solid-state cells require a critical innovation to function reliably: specialized anode materials that manage lithium-ion deposition without dendrite growth. Extensive research has identified silver-carbon nanocomposite anodes as the most promising solution. Silver atoms act as nucleation sites that distribute lithium ions evenly across the anode surface, preventing the concentrated deposition that creates dendrites. The silver content in these anodes represents not trace amounts but substantial material loading, potentially 50 to 200 grams per vehicle depending on battery capacity and performance requirements. This technological shift creates unprecedented silver demand patterns that differ fundamentally from traditional precious metals consumption. Unlike jewelry or monetary applications where price sensitivity can reduce usage, solid-state batteries require specific silver loading to function safely. The chemistry is non-negotiable. Reduced silver content allows dendrite formation to resume, compromising battery safety and performance. Industrial users cannot substitute alternative materials without accepting significant degradation in energy density, charging speed, or thermal stability. The scale of potential demand transformation becomes apparent when considering automotive production volumes and electric vehicle adoption trajectories. Global automobile manufacturing approaches 90 million units annually, with electric vehicles capturing approximately 15% market share currently, but projected to reach 50% by 2030 under moderate adoption scenarios. If solid-state technology captures 30% of the electric vehicle segment by 2035, additional automotive silver demand could exceed 100 million ounces annually. Conservative estimates assume 75 grams of silver per solid-state battery pack, accounting for both anode materials and enhanced electrical components required for rapid charging systems. Moderate estimates suggest 125 grams per vehicle as manufacturers optimize for maximum performance and charging speed. Aggressive scenarios driven by premium vehicle segments and commercial applications requiring extreme rapid charging could approach 200 grams per battery pack. Current baseline global silver consumption approximates 1.2 billion ounces annually across all applications. Industrial demand accounts for roughly 700 million ounces, with solar photovoltaic manufacturing representing the largest single category at approximately 200 million ounces. Adding 100 million ounces of automotive demand represents a 14% increase in total consumption, but this calculation understates the impact because it assumes linear scaling across existing supply chains. The mathematical reality proves more complex because solid-state battery deployment will coincide with continued solar industry expansion. Photovoltaic silver demand is projected to increase 170% by 2030 as installation rates accelerate and panel efficiency improvements require higher silver loading per unit. Combined automotive and solar demand growth could approach 400 million ounces of incremental annual consumption within the decade. This demand increase equals approximately 50% of current global mining output occurring simultaneously with existing jewelry, electronics, and investment consumption. The numbers suggest a fundamental mismatch between technological deployment timelines and geological supply constraints that no amount of price adjustment can quickly resolve. Supply response capabilities remain constrained by physical and operational realities that financial markets consistently underestimate. Silver mining production has remained essentially stagnant since 2014, averaging between 820 and 850 million ounces annually despite significant price appreciation over this period. Approximately 70% of global silver output occurs as a byproduct of base metal operations, meaning production depends primarily on copper, lead, and zinc demand, rather than silver prices directly. Primary silver mines contribute only 30% of global supply, severely limiting the industry's ability to respond to price signals through dedicated production increases. New mining projects require 10 to 15 years from discovery through permitting to commercial production, meaning supply responses to current demand growth remain structurally delayed. Meanwhile, existing operations face declining ore grades that require progressively more energy and resources to maintain output levels. Geological surveys indicate silver ore grades have decreased approximately 60% over the past 2 decades as easily accessible deposits become depleted. Modern silver mines extract 4 to 6 ounces per ton of ore compared to 12 to 15 ounces per ton in operations developed during the 1990s. This degradation necessitates processing significantly more rock to produce equivalent silver output, increasing costs and environmental impacts while limiting expansion potential. The Shanghai premium persists because physical reality has begun to assert dominance over financial theory. When technological revolutions create inelastic demand for materials that geological processes cannot quickly replace, markets adapt through pricing mechanisms that reflect scarcity rather than speculation. The data suggests we are witnessing the early stages of this adaptation, where regional supply security commands premiums that traditional arbitrage cannot eliminate. The phones that went silent at 3:17 a.m. Shanghai time may have been reconnected, but the conversations they carry now occur in a materially different market environment than the one that existed just months ago.